Welcome, everybody. This is the ESOP Guy. We are on a journey to an ESOP and excited to be with everybody today and talk through, I think, a very important topic, which is how warrants work in an ESOP transaction. And to do that today, I've invited Will Rodriguez, who is the founder and owner of Vision Point Capital, and really help us on the side of how the trustee looks at warrants. And then as we go through this, we're going to go into some example formats to really help solidify how it actually works from a math standpoint. So I'm excited to have Will on the podcast today. And like always, if you have an interest in this podcast, please go to our website at journeytoanesop.com and you can check out all the episodes and learn more about ESOPs. So with all that, Will, thank you for joining us today.
Thank you for having me, Phil. Excited to be here.
Great. So Will, before we get started, I wanted to just ask you, as we get closer into the holidays, what is your favorite holiday movie?
Hands down, Home Alone, the first couple. I don't know how many they had since then, but the first one or two for sure.
Home Alone 1 when they're in Chicago, Home Alone 2 when they're in New York.
New York.
Those are awesome. Okay.
Those are the only ones that register on my radar.
All right. So put that on your list of movies. That is one on our list every year. We watch that with the kids. But all right. So jumping into this, Will has been on our podcast. This is his second time. But for those that have not heard Will before, Will, tell us a little bit about how you got into ESOPs in your current practice at Vision Point Capital.
Sure. Again, Vision Point Capital, founded here in Tampa Bay area. We essentially do one thing, and that's we move business owners to a better place. And again, of course, using our services, which of course ESOP advisors is a big component of that. We work with ESOPs all across the country. We've probably performed over 200 ESOP transactions in our 15-year plus experience in working with ESOPs and the related advisors. And again, what really generates, right, is we call it the triple win, right? The win for the sellers, the win for the company, and the win for the employees that, ESOPs create, and employee/community. Because again, keeping that business, tied to the community and, all the goodwill that it creates, is really important in today's world.
Absolutely. So, Will, as we talk about this, as we start going into the topic of a warrant, I think it's important because there's some people that are probably going to listen to this that they're like, I don't even know what you're talking about. What is a warrant? So let's start off with just explaining the warrant as if we were explaining to somebody who's never actually heard about that. And we're going to then tie it into the transaction itself.
Yeah, to try to keep it simple, right? Warrants are, again, kind of akin to a stock option. So the holder, the owner of the warrant, essentially, gets value in the company stock over time. It's usually set at a strike price, usually a nominal strike price. So again, it's a way to incentivize, at the beginning of a transaction. So maybe a seller to take a lower kind of stated interest rate, especially, in the ESOP transaction. Generally, if we look at the capital structure, usually there's senior debt. So generally that's a bank. And then there's subordinated debt, which usually that's where the seller notes fall under, right? And then they're just pure equity. So giving of course, the seller, the senior debt has first right to everything, right? It generally is, the market rate is the market rate. But that seller debt, that subordinated debt, again, it's really more akin to mezzanine financing. And so if you look at the mezzanine market, the rates of return that's required, you're going to see anywhere from, 10 to 20% and up, depending on, definitely if we look at the current environment we're in, right, the cost of capital has gone up significantly, over the last year. So again, it's just a way to try to bridge that gap of maybe paying a lower amount of interest cash flow out in the beginning, but then giving that warrant holder, kind of a second bite of the apple in the back end.
Yep. Yeah. So I'll kind of say what he said, but just in a different way. The whole thing about an ESOP transaction that gets asked is, how am I going to get my money? And so the bottom line is you're going to get your money as the selling shareholder when you sell your stock, and in exchange for that, the bank is going to finance part of the transaction. In most cases, that's going to be the way the structure is. The company's going to borrow the money from the bank. They're going to give you that money as a liquidity event. And then anything that's left over is going to be made up by the seller note. And the selling shareholder has the opportunity. They don't have to do a warrant, but they have an opportunity to utilize a warrant for some of the benefits that we're alluding to when we get into this. So the seller note itself is as a selling shareholder, your risk that you take by lending the money to the company to buy out your stock. So in compensation for that risk, just like the bank, the selling shareholder can get an interest rate. Now, without a warrant, that interest rate is going to be higher. With a warrant, that's going to be lower. And it really depends in the current interest rate market what the actual rate's going to be. And like Will had said, kind of comparative to mezzanine financing, the selling shareholder is taking more risk because they're at the back end of being paid. And so their rate's going to normally be higher anyways in the senior debt. And then the warrant on top of it really then incents them. And the way that this works, the reason people are okay with this structure in general, when I say people, I mean the trustee who is buying the company. And I also mean the bank, and in some cases, the bonding company, is that the company is going to finance a leveraged transaction and have a lower interest cost at the front end of the deal, which creates more cash flow. So the warrant is a very useful tool, not just for the selling shareholder to get another bite at the apple when it's all paid off, but also through the process of actually helping the company, make the payments through this whole process, so that everybody wins in the end. So the company does, the trustee does, the employees win. And so that's why warrants are very important to understand, and they're very popular to use in an ESOP transaction, but they have to be used specifically the way we're talking about it. So that kind of sets up the next discussion topic is the limiting factors using a warrant, because they are a negotiated tool. It's not something that, as the sell side advisor, my role is to try to get the client, the deal that they want. And on your side, Will, you're representing the trustee.
Right.
You have the limits on your side. And so let's talk a little bit about some of the limits in using warrants for ESOP transaction.
Right. So as we all know, right, the transaction is kind of where the Department of Labor, which is the government watchdog of ESOPs, right? Now that's where they're going to really dig in and try to, make sure first independence, right? As Phil mentioned, he's on the sell side, there's sell side team. He's working with the owner specifically. And the majority of the time, our firm is on the buy side working for the trustee. So again, we wouldn't be the financial advisor of the valuation firm to the trustee if we've worked for this company, in capacity in the past, because again, our independence would be blurred there. So again, you're the sell side, we're the buy side. We're providing our valuation and financial consulting to the trustee. So again, we look at every company, independently, objectively, and for example, we'll give an example company here, later on, but let's just say our valuation comes in. Okay, we got a range of 18 to 22 million for this company. So again, that's what I would relay to, the trustee, and obviously Phil's done his, he's relayed some similar message to his side. And so, as we've talked about, I think on prior webinars, et cetera, ESOPs are unique in that the sell side, it's kind of reverse M&A. The sell side actually presents the first offer versus in a traditional M&A transaction. Usually, it's the buyer presenting. But in once the purchase price is negotiated, right, as part of that negotiations, it's just not the headline price. It's it's all the other stuff, which again, warrants will or will not be included. And I would say about 50% of our transactions probably have SARs or warrants, or both, right? So again, stock appreciation rights when we think about SARs. But that being said, we're focused on the warrants here. So from our side, as we negotiate, we have to say, well, what is the proper kind of rate of return, right? So if we agree on a 5% interest rate for the seller note, we know kind of the market's probably 15 to 20%, as I mentioned before, mezzanine. So, maybe we target a rate of return, which we back into the number of warrants that equates to as far as the shares, for dilution purpose. But then again, we have to always consider, again, you got the DOL, or it's arm's length, we've got to issue fairness opinions here. What's a proper amount? We can't be too dilutive. Again, you're paying $20 million for a company, right? But, oh, we gave them 40% away, in SARs, without maybe justified, right? So again, it's all a negotiation process and facts and circumstances. So each deal is looked at independently there.
Yeah. So kind of in keeping with what you're talking about, just so we really can explain it, as far as the dilution happens, the ESOP stock value in the future, as we go from the close of the transaction into the future, directly affects the ESOP participants. So the value of the stock itself is going to be diluted by how much warrant gets approved and SAR, but that's a whole nother topic. But both of them work in tandem because they're both forms of synthetic equity that have to be considered when all of the actual net negotiations are over. And so on the trustee side, they can't dilute the stock too much because then that takes away from the ESOP account holders. And so that's definitely one limiting factor. I think another limiting factor is just the cost of what the trustees paying for the transaction, as far as between what the company has incurred in bank financing and the cost of capital there. And then in addition to that, they have to pay for what they're actually net paying for the stock, which is includes the purchase price. And it obviously includes what they're going to pay out with these warrant payments, as well as all the interest that goes into it. So if your warrant, one of the limiting factors is the warrant could be a huge part of the purchase price when you get down to it. So there's going to be a balance in terms of those that have to be considered. And from a selling shareholder standpoint, I think the part of this is to think about why would they want to have a warrant in the first place? And because this question gets asked to me all the time, and because they are taking some risk as the selling shareholder, lending money to the company. They're taking, if they don't, first off, they're going to lose some interest rate that they would otherwise be entitled to. And secondly, their note's not going to get paid off. They have to wait until all the seller note gets paid off to get their money for the warrant. So they're in a higher risk situation. And so the selling shareholders, and in my experience, are okay. And a lot of times with that risk, because they've already lived in the actual cash flow risk of the company, or they see the future potential for the company.
Yeah. And Phil, as you go through and you help your clients usually with the projections, things on the front end, right? So, the trustees, as you said, is not just purchase price, it's the deal in totality, right? So again, the trustee has got to, be comfortable with, where we land at for kind of in totality of this deal. Now, for example, in my earlier example, if I said 18 to 22 and say we landed at 18, right? So we know we have some buffer. So we may be open to more warrants in that scenario because we know we've got a good deal and we got some buffer, versus if we're already at our max 22, I mean, we're going to be very stingy on the number of warrants or how much more we kind of want to give if we're already feeling like we're paying kind of at the top end of our range. So again, it's ebb and flows of facts and circumstances. So kind of have.
Yeah, I think, and that is a good point, because when you do plan a negotiation or you're planning the ESOP, you need to think about maybe I'll give up a little bit more purchase price to have a little more warrant, or vice versa, depending on the appetite for risk. And there's the other side of ESOP I think is just interesting, because it's not just a pure financial business deal. For some clients, it's, hey, I really want to support the company's ability to succeed. And I let me just say it that way. I think that's critical to any ESOP transaction, that the owner really wants it to succeed, because they have a long-term stake in it. But the other part of it is just, hey, that's the right thing to do. We want the employees to win. And so these are variables that are going to play a role in how much burden the company is going to have to, go through to pay off all the debt related to it. So
yeah, and again, if the projections don't turn out as planned, right, then those warrants, wouldn't be worth that much on the back end. And so the trustee, again, it's not, they're not paying out because again, they didn't reach their projections and the value's not there. But again, the majority of the time we see that they hit their projections, and they're getting a nice chunk of change at the end, which is it's kind of a win-win, as you mentioned, that the company's grown in value, may above the purchase price, so therefore the owner's going to get some additional upside there.
Yeah, exactly. So we get into the actual specifics, and just as we go through this, we're going to get into your case study in a second. The way that we talk about, and this is why ESOP stuff can get confusing, because we always start throwing out terminology for people, and we just expect you to know what that means, right? So as we go into that, it's going to define a few terms as we start thinking about it. The warrant, as we said before, is connected to the seller note. So the only way you can use a warrant in an ESOP transaction is by connecting it to the seller note. It is connected to the overall value of the business, the way it's actually going to pay out. But the actual connecting point is that we're going to negotiate around the seller note. And so within the seller note, one of the definitions is we're using a term called internal rate of return, which really is just a finance concept that says, if I have an investment, what is the overall internal rate of return of that investment from the very beginning of what I invested in, and then at the very end of all the payments received. So I don't know if you would add to that, but I just want to make sure that that's foundational to people, like understand, like that's going to be something we're going to talk about in terms of how we negotiate a warrant in an ESOP transaction.
Yeah, and as you mentioned, the debt that's being financed is subordinated, meaning it's not first in line. So therefore, there is more risk. And say, for example, you get a 5 to 6% bank financing. Rates are going up. I mean, we're seeing higher than that these days, it seems like. So of course, you're going to expect a higher rate of return than just if you were secured financing, but you're not. So again, it just gives justification for, as we talk about, but maybe it's a 5 to 7 year payout of the bank debt before you see a dime. Maybe they don't even let you get interest payments. Where are you going to lock your money up for 7 years without any cash? What would your expected rate of return as an investor? I have worldwide amount of investments, alternatives I can invest in. I'm doing it in my own personal closely held stock here, but what would I need to compensate for that lockup period?
Exactly. So what happens in a transaction is, on the sell side, we put together an offer letter, and in that offer letter, we're going to have we're going to have a purchase price. We're going to have the bank financing identified and the seller note identified with an interest rate for the seller note to negotiate with the trustee. And then when we're adding a warrant, we're going to add, we want a warrant that is going to equate to a specific IRR. So that could be, hey, 15% internal rate of return, or we start at something higher and then the trustee comes back. And then in that offer counteroffer scenario, what Will and the trustee are doing is they're reviewing that with what they're okay with Will's work. And then they're going to come back, and eventually between the offer and counteroffer, we're going to settle on an internal rate of return. So then, okay, now what does that mean? So I want to kind of build that up, but now we're kind of ready to talk through the case study to show actually how the calculations of that IRR turn into number of shares. And then there's this overall prediction of what we think it's going to end up turning out to be, which nobody really knows. It's just the way to do the math, because nobody can really be, knowing the future. So with that.
Yeah, well, as you were mentioning kind of the limiting factors earlier, right? And I meant to throw out complexity, right? Because you're going to see as we go through the scenario, there's a lot of inputs that's, again, they're future projections, they're assumptions, right? We're making a lot of assumptions here, as far as what the business is going to do, where it's going to be 10 years from now, and also where the economy and the industry that the company is in is going to be. So again, we know this isn't perfect, but obviously it's as of a point in time. This is negotiated, as of a certain date. The valuation is at this date, and it's giving the best information we have at this point in time. So,
okay,
let's open up.
So we're going into a spreadsheet document.
Yeah, and I'll try to keep it where it's legible.
Yep.
All right, so we're going to start, as kind of I alluded to before. Let's imagine we have a $20 million, and we're going to do a 100% transaction. And Phil, as far as we haven't touched on this, typically we see these in 100% deals, but what percentage of non-100% deals do you still see warrants in?
For me, I'm still at a 50-50.
Right.
Yeah.
No matter controlling or 100% or not, still about 50-50.
Yeah. And I just think because partly people are becoming more and more aware of the the opportunity behind how a warrant can help fund the transaction.
Yeah.
And I know that part of that is helping help people understand the very front end of the planning process, that there's a give and take. If we decide to use them, then maybe we have a little bit lower of a purchase price. When you net it all out, as we said, it's not going to be just, hey, we'll just throw warrants in. So as we talk about complexity, there's a lot of that planning that needs to be done in conversation. It's probably a lot easier just to keep it really simple at a smaller percentage non-controlling interest and then layer warrants in later. But sometimes people just really like the idea of warrants, and so we just have to kind of be flexible when we're on the sell side.
And one thing to mention that maybe is again, most of our ESOPs, we require some type of CPA financials, usually reviewed or audited, right? So again, that's going to be accounted for. The SARs or the warrants will be accounted for. And when we mention SARs, the stock appreciation rights, synthetic equity, but so again, that all gets kind of factored into your financial statements. And some people, they just don't realize what that means until, you kind of have to go down the path with your CPA. So anyway, just as a heads up.
Mm-hmm.
All right, so here we have $20 million transaction. We're assuming we can get $15 million of senior debt, bank financing, which leaves us with a $5 million seller note, which again, so very simple math there. So the $15 million senior debt, we're going to assume it's a 7-year term, 5% interest. And so you kind of see the amortization schedule of, the 15 million principal getting paid down to 0 over those 7 periods. So again, you got interest and principal on that note. Then the 5 million, essentially in this example, we are assuming we're going to get the interest paid in the same period. So a lot of times what you will see is that the bank won't allow any interest to be paid until they're paid off. So this essentially would be accruing over time. But in this example, we're assuming that it gets paid out as well at a 6%. So here you can see, okay, in the first 7 periods, we're just getting paid our stated interest rate. And then we start, since we have more cash flow, we've grown and we got the ability to pay this note off in 3 periods. So total 10 periods to pay off the total transaction debt. And so you'll see these debt schedules as far as the amount of debt kind of come into, like, here's our EBITDA forecast that should be taken, or, we would take it from the valuation, the projections provided by management. And again, for those on the call, when we talk about EBITDA, it's earnings before interest, taxes, depreciation. It's used as a proxy for cash flow, even though you'll see, it's not pure net cash flow. And for example, we usually have CapEx, working capital, and obviously taxes are, usually a big component of cash flow out, 30, 40%. So in this example, I said it was 100% transaction. So we're going to assume we're 100% S Corp ESOP. And so we don't have taxes anymore. So that number, obviously increases our net cash flow because we don't have to pay taxes, which, as you'll see when we start to service the debt, right, makes a significant impact in our debt service. So we're able to, again, if we have 4.4 million of EBITDA and say net million of 3.7 cash, our debt service is 2.9, for the first 7 periods, and then we pay off the remainder over time. And then again, you kind of look at what's your excess cash flow. And we know this isn't perfect, right? Some of that cash flow may be used for other items as well. But again, as we're sitting here at day 0, we're trying to model out, kind of the best case scenario.
Yep.
So now those are kind of the inputs.
Yeah. Can I say something too, as you do this?
Sure.
The reason we're going through the mechanics of the cash flow, because it's building up to help us to understand how the actual warrant's going to be calculated. Because at the end of the day, what Will's going to have to do is show where is the company in the future period, assuming a couple of major variables here. We can't assume everything, but the major variable is we have debt service because of the transaction. That's going to require the company to pay that out. And then the things that he had summarized in that debt service is you have the senior debt, which is the bank financing, plus the seller note. In addition to that, because the company's continuing to grow and have different things happen, you're going to have more working capital required in the future. And you're also going to have this CapEx, which is the capital expenditures that the company has forecasted to purchase more fixed assets that they're going to need to continue the ongoing operation. So part of what he's doing is just laying the groundwork to show, like, how do we get from after the transaction to the future period, and really have an estimate of what actual cash is going to be in the future and what the actual value of the business is going to be when we get to the future. So just kind of another way to look at what you put down so far.
And as of course we mentioned, right, whose crystal ball is better here? We would have spent a lot of time with management. For example, it looks like these are kind of come from the first, we get a 5-year forecast, and then our assumption for what, years 6 through 10, I think I just used a straight 5% growth. But again, this is all kind of understood as the valuation, going back and forth, speaking with management, trying to get comfort, from my side, the trustee side, on what's the proper kind of forecast, EBITDA forecast, cash flow forecast, and again, are we really seeing this company be able to hit $7.5 million 10 years from now? Maybe yes, maybe no. Maybe we go. I
guarantee you one thing: we're going to be wrong.
It'll be
either above that or below that. We just want to try to get it as close as we can.
Yeah, and as of time zero here, like, we're just trying to get the best arm's length negotiation and all the information on both sides, as much as we can, understood and agreed upon. So that being said, now we'll go to the more of the calculation side. So what was what did you want to target, a 15% IRR?
Yeah, so we did a great job negotiating. We get a 15% IRR.
All right, so I'm going to start out and just, we're going to assume there's 1 million shares outstanding, and so then any additional warrants will be, in addition to that. So I'm going to go with 150,000 to start, and we'll see if it's kind of a circular calculation through here. You'll see me adjusting and getting to the number, but at least this will probably put us in range, and we'll adjust it as we go.
All right, we'll go back for a second. Let's just talk about the details you have in this summary of purchase price. Right. Table. So what we're doing is we're starting off with the actual $20 million valuation that we ended up negotiating, right?
Exactly.
And then you have, from there, you're basically just saying that this represents 100% of the company. Again, that makes everything a lot simpler because we don't have a partial sale. And then we're talking about, when we say numbers of warrants agreed upon, we're talking about the number of shares, because they're synthetic equity. They're not actual real shares, but they're the number of shares based on this negotiated internal rate of return of 15%. And as Will said, it's going to be circular as we get into the details, but we're going to start off with an assumption that we're going to have 150,000 shares that would be issued to the selling shareholder as part of their seller note. Correct? Anything
Correct.
else?
Just at a strike price, which is usually around $1 for a 100% transaction. But
before we move to the strike, on the strike price, that's technically your day 2 price, right, on an ESOP transaction. Right. So let me just explain that real quick. So if we negotiated a $20 million deal day 1, the next day that value goes down immediately because we just put $20 million of debt on the balance sheet. And so the only residual value we have is really the ESOP tax shield that we have as an S corporation. So that's where the $1 a share becomes our strike price for these warrants specifically.
Right. And nuance of that is, sometimes we have owners that, hey, the company's worth $2 million and they want to give it away for $6. They agree to $6. So then, as far as what's the day 2? The day 2 value could be argued that it's more than, say, $1 because we got a bargain purchase. So those are nuances of whether where you want us to set the strike price or not that kind of come up sometimes. But in this example, we just arm's length $20 million transaction. And we're just making simple math here. So we're going to have $4 million of EBITDA at a 5x multiple to get us to our 20 million. And again, so this is year 1. So I think we've got 12/31 as our kind of day 0. So we kind of stay flat for the first year, 20 million. And so, of course, 1 year after the transaction, instead of $20 million of debt, we got 18. million, which has come from this tab here, and then we had a little bit of excess cash flow, as we said, residual cash flow left over. So that gives us to 2.63 million of equity, and then there's valuation discount, DLOM. So again, it's discount for lack of marketability. It's essentially, just think of a marketability discount as you're not Apple, you're not Google. You can't sell your shares on the exchange, get your cash in 3 days. But an ESOP does create a put option where, again, you can get it redeemed. It's just not, not liquid cash. So when you talk about DLOM, just think about it at that level, that justification. So as we talked about before, above, there's 1 million shares outstanding. That gives us a value of $2.50 per share. And so if we set the strike price at $1, on the transaction, that will give us, year one kind of increase to $1.50 a share, which is justified, right? Because we pay down debt and we added some additional cash. So again, where does the appreciation come from? It comes from, kind of that scenario. So again, just like as you pay down cash, you can see the debt being paid down. You can kind of see the equity value really getting charged, increasing. And we are making the assumptions that, the company's EBITDA is growing, say 10%, I think, for the first 5 years, and then 5%, as I mentioned, in the later years. And then, of course, we're assuming that, okay, it's kind of standard. As a company grows, so would the expected kind of multiple it could achieve. So again, some appraisers may keep this steady, constant throughout the forecast period, which is fine. Some may account for that change. So again, going from a 5 to 5.9 over 10 years, to me, is reasonable. But again, that's kind of an appraiser's judgment there. But you can see the enterprise value go from 20 million to 44 million just on the cash flow, current cash flow of the company. And then, of course, we've got the debt that's paid off after 10 years. And then we have kind of that excess cash above the debt service that we've seen kind of getting built up from this schedule as it's tracking along. So again, this number is probably, would be adjusted or, somewhat maybe reserved, because who knows, maybe, we made some acquisitions, we did something else, but then we have to readjust our forecast. So at a very basic level, we're keeping that constant, but that would be something, we may need to consider. It may not be on the balance sheet. That's
a good point. It's hard to know what cash is going to be in the future, but with the modeling like this, you can't do a lot of business planning at this point for the company for 5 or 10 years. We don't know. They might buy a company, but
they might buy a company, spend 10 million. They spend the 10 million, but then this goes to 8 to 9 million, right?
Exactly. So it could factor back into, hopefully they did the right thing and they didn't have a problem with that, but it factors back into the valuation. So I think it's really a safe bet just to keep the residual cash in there. The thing I would say about residual cash too, though, and this is just some kind of a side point, is that once you're an ESOP, the company doesn't need to do anything but pay debt off. On 100% ESOP. The company's purpose in life when they start out is, of course, they're going to do what they're doing. But my point is, when you own the company, of course, the company owner is pulling cash out to do all these things. But once it's been 100%, that cash just sits in there to prepay debt. And then when so you're going to have a large excess cash line item in ESOP companies.
That's very normal. Or like I said, we know that repurchase obligation, right, is a key component of ESOPs, probably, and that takes time because out of the gate, it really doesn't build up. Things haven't allocated, debt hasn't been paid down. But by year 10, right, it could be a, somewhat of a number. So that again, you've got X amount of cash to pay it off, is there really a challenge? So that's a topic for a whole nother discussion, but we're kind of assuming that's neutral at this point. And then now it gets to, year 10, we've paid off, and now we're, able to pay off the warrant. And kind of what's the warrant going to get paid off, which this is where we get into a circular calculation. And again, I just got 10,560,000 in here as a kind of placeholder for now.
For the actual warrant payment.
For the warrant payment. So now if we take a look at kind of the seller's cash flow, right, we got the $15 million from the bank. And then we made the assumption that, we're going to get our $300,000 of interest paid. And then we started getting our $5 million of the seller note, paid here as well. So, and so now it's the question is how much is that warrant? And so this is kind of where we set the circular calc. So again, I'm going to try to solve for the exact number. You can kind of see it's just going to play it by ear here.
Well, while you're doing that, I'll just comment on what Will's doing. The whole thing with the warrant we're calculating the value of the business in the future. So the per share value of the business, as he illustrated appreciation per share on the one table, is going to be a factor of the future value, which is partly the EBITDA that we've projected, is partly the multiple that he's projecting in the future. And then it's also related to how much what the balance sheet looks like. So you have your enterprise value, and then the future balance sheet is going to have no debt, and you're going to have a residual cash so all of those are going to play a part in the future value. Once the future value is calculated, all we're doing is subtracting it minus the strike price per share, and then we're multiplying it times the number of shares that we're estimating to come up with the actual warrant payment.
So you can see we had 150,000 that we estimated. Our appreciation since the beginning was $58.96 to get us to 8.84 million. And again, I kind of back solved. I did a manual calc to do it. You can do some type of formula in Excel, but again, solve a formula. But again, that's just kind of a simplistic way. And so now we kind of get to what our cash flow and get to what our, so we said 15% was our, and
yeah, we target.
Was that lucky? Was that lucky or good that we actually essentially came out to 15.1% as IRR?
There was no luck there, my friend. You're really good at this. So it is, part of it is circular. So we can kind of say, well, but ultimately what we're doing, what Will do in this scenario is like we negotiate it. He'll go back, do this math, and this is where the shares come from. Because people are like, well, how do I know the number of shares is accurate? Well, this is how we know, because it's the future. As long as his assumptions are reasonable, then that should yield number of shares of warrants that gets us to that right target IRR. And that's a big part of the whole process. You
can see at the end of the day, right, we had a $20 million transaction, but in 10 years, the seller actually gets $31 million. So, it's a significant increase above, a third more than, 20 million. Of course, it's over 10 years, right? Your money, you would be earning a rate of return in the marketplace, assuming, not the recent market. But that being said, 15%, if you invest 5 million and get a target of 15% over time, you should get close to what this amount will give you. Now, of course, the offset to this is, as a trustee, what if in year 10 we're at $5 million? Okay, there's still appreciation, but it's, it may be, a $5 million payout. So again, the trustee is like, okay, we didn't hit necessarily the top side, but I'm not having to pay out the warrant at that level I'd expected anyway. So there's risk, shared risk on both sides.
Yeah, so that's what's interesting about the whole process. Anything can happen. So if the company goes down, the trustee will be paying less for the company. And if it goes up, it could be more than the 8.8. The 150,000 shares could be, if he's at 9 million in EBITDA in the future period, the nice thing is the seller is going to be able to be rewarded for the value of the future business. And so that's I think an interesting part of it. There's really no ceiling to the warrant payment. It's just
but both sides are motivated, right? So we had a $20 million company that's now 45 intrinsically, ignore the cash. So again, why wouldn't, right? We kind of share it, be motivated to share that growth, because again, it's kind of a win-win as well. So it makes sense.
It makes sense, and the cash is going to be there. It's like if they're doing that well, they're not spending cash on other things, so the cash will be there to pay off the warrant. So I think some people are like, oh my gosh, if they had to pay 10 million in future value for the warrant payment. But that would be only if the company was hitting the EBITDA targets and has the cash. So if it's not valued, it's not valued. And so it does self-regulate, I think, a little bit more for people. Because when I think people gravitate towards negative, like, oh, they're going to have to pay a lot of money in the future, but they're only going to have to pay this money out if the business is truly valued at that level.
Right. And say the cash wasn't there, right? Then say this is zero. What's that going to do? It's going to lower the share price. It's going to lower the amount that's paid out.
Yep.
Even if the EBITDA, they hit the EBITDA, right? So again, kind of manage where that cash is going. Because again, you would think at this stage, like you're putting your money to work at some level. So again, that's not being wasted. So what are you going to do with your kind of excess cash? Again, you're not paying taxes. You're out of debt. Again, make some acquisitions. Additional capex. Grow the business as you can.
Well, that's great. I think just as we close out, my thing is, it's really, at least from my experience in working with people, it's easier to understand a concept like warrants when you actually see how the math works. And so for that, I thank you for that, Will, because there's a lot of numbers here, but when you break it down to the fiscal periods and you start really just thinking about the items here, I just think it makes good logical sense.
Yeah, and there's different people solve this differently. This is kind of how we approach it. But, and again, you may solve and get different inputs, right? But we should be relatively close at the end of the day. So maybe you come up with 175, we come up with 150. Again, it's a negotiable item. That again, a good deal is a good deal for everybody. That's the key thing.
Yeah, I think that's a good point too. There's probably a few different ways to do this but at the end of the day, it's all going to be pretty close to what we're coming up with. So, well, great. Well, so with all of that, I wanted to kind of say again, thank you, Will, for walking us through that. It's a big topic, and there are probably going to be questions that we just created for you, but that's okay. Talk to the people that you're comfortable with in the advisory world. If you want to email me on the journey to an ESOP, you can always do that. But the big thing, we just want to make sure you understand how they're used so that you can ask the questions and structure those in your transaction if you feel like that's something you want to take advantage of. So, but thank you. Any final comments from you, Will?
Well, again, just love being a resource in the ESOP space. Any questions or follow up, happy to help.
Great.
Thank you so much for having me on. I appreciate it.
You're welcome. And I'm sure you'll be on again another time to do some more math for us. So,
all right. Sounds good.
Thanks. So with that, everybody have a great day. We'll see you on our next step on this journey to an ESOP.